Val. I'm an accounting lecturer. I'm actually not with FAC 1502. I'm with FAC 1501, but I will be presenting today's facet class. Today's facet class is about cash and cash equivalents. So we will be working through your study unit 8. We will work also through one of the revision exercises, so that if you then later want to go back, you can then also work through the revision exercise on your own, just to make sure that you understand what we have done. So welcome everyone. I hope you're going to learn today and that you will be able to especially do bank reconciliations, because that's basically the important part of this study unit. So I'm not going to waste any time. I also have my two colleagues, Mr. Sihanda Mkadi and Mr. Motlatlana Mukokone, who will be answering your questions. You will see that you can't ask any questions live, although you can type your question and then they will answer it for you. So if you still have any questions at the end, we can then address them at the end after I've presented. Sianda, can you then start, that we can then start with my presentation?
Yes, thanks, Dion. We can start with your presentation then.
Thank you. Can you see it?
Yes, I can see your presentation. Let me send it live then.
Okay, so I can then start.
Yes, you can start now. It's live. Thanks. You can switch off your camera then.
Okay. Once again, good afternoon. Thank you for joining myself and my two colleagues, so that we can start now with today's presentation, which I've mentioned is the cash and cash equivalents. It's study unit 8 from your study guide, the FAC 1502 students. The FAC 1501 students who are also joining, you will also be able to learn from this, although we're going to work with the study material from FAC 1502. You as FAC 1501 students also do this in Learning Unit 8. So definitely you will benefit from this presentation as well. Now let's start. Our cash and cash equivalents lecture today will address the following. After we've worked through this presentation, you should be able to understand the nature of cash and cash equivalents. So it's going to tell you what is cash and cash equivalents. Secondly, you will be able to understand the internal control that one needs when cash is involved. Also, then you will understand the reconciliation of the bank statement balance with the bank account balance. You will remember the bank statement is something that you receive from the bank that you bank with, where the bank account balance, that will come from your bank account that you've prepared in the general ledger. So there is the bank statement coming from the third party externally, and then internally you will have your bank account in the general ledger. Then you should also understand the petty cash journal, because remember, we have cash transactions where most of them, all the big transactions, all the big cash receipts will go to your cash receipts journal. and then all the big payments will go through your cash payments journal. Your petty cash journal is more an internal journal that you're going to use for small payments where you quickly need to go and buy some milk or tea or coffee or sugar for the office. And I mean, you can't wait for someone to first approve or you don't get a quote for something and then have to fill in a purchase order, and then you must get it signed off, and then the payment must go through. I mean, these are small amounts, 10 Rand or 20 Rand, where you quickly need, yes, you still need to complete documents, but it's far less than when you need to do a EFT payment. And then at the end, we're going to do a revision exercise. Now, the nature of cash and cash equivalents. Remember, on Thursday, Mr. Mkadi went through the books of first entry. Now, he explained to you your cash transactions, which you use the book of first entries. There are the cash receipts journal for all cash received, and then the cash payments journal, which is used for all cash payments. And then you had your creditors journals, your journals that you use for credit transactions, like your purchases journal and your purchases returns, your sales and your sales returns journal. Now, your cash and cash equivalents, that is part of your current assets, because you remember current assets, it's anything that you will, where the value of an item will change within 12 months. So for instance, your inventory, you're going to make use of it within 12 months. You're going to buy today, tomorrow you're already going to sell it. The same with your debtors. At the end of the month, where the customers that bought on credit, those are your debtors, they then going to pay you probably within 30 days. So it's things that change within 12 months. It's there for a short period, and it's less than 12 months. Anything longer, that's going to be your non-current. Now, your cash in the accountancy environment includes coins and notes, which you all know. Postal orders for the older people, someone like me, we used these quite a lot in the olden days when we had to do payments. You could go to the post office, get a postal order for a certain amount. You could also have used it for paying traffic fines and stuff like that to send it to the traffic office. But yeah, they're not really in use anymore. Then checks. And yeah, checks, that one has used so much. You've written out a check for your school fees, you've written out a check for your study fees, you've written out a check, you send it in the mail. But these days, yeah, the banks have informed clients that that's not going to be used anymore. It's not a legal payment method anymore. So there, the time of checks have been or came to an end, and now these days everything is going to be more electronically. Now we all also know about credit cards, where you can go to the shop when you don't have cash with you, and you need to make a payment, and you have your credit card. You can swipe the credit card, you can tap the credit card. There's also apps that you can use for payments if you want to buy online, or when you pay someone and you have a smartphone, you can use Zapper or SnapScan to do the payments. And then the electronic funds transfer, your internet banking. that's got basically now what's happening. Businesses are now using EFTs, internet banking payments, to do most of their payments. So our EFTs have now replaced the checks, and that's now something that you're gonna see from now on and in the future, except if someone else come and invent something else. But most of the time, businesses will do their payments by using the internet banking. Now, cash equivalents also include savings accounts or any investment that can be converted into cash in a period shorter than 12 months. Now, if you have a fixed deposit, that is normally for a period longer than 12 months. So that's not going to meet the criteria of our cash and cash equivalents. That's going to be part of our non-current assets, because fixed deposits are normally for a minimum of a year, so it's going to be longer than 12 months. Whereas your savings account, I mean, that's lying there with a balance. You're going to withdraw money today, you're going to deposit money the day after, so that changes quite often. So that will also be part of your current assets and your cash and cash equivalents. Now, with cash is something that needs internal control, because I mean, cash is very important for a business, but it's also something that can disappear. I mean, unfortunately, there are people that would not always follow the rules, and some people that are greedy, that wants to enrich themselves. So cash can be a problem if you don't have control over it. So a payment request must be signed off by at least 2 different employees. Now, when you prepare that payment request, it must be authorized by those 2 people, because I mean, if it's only one person, then that person himself or herself, you know, can make a payment, an unauthorized payment to herself or himself. So if there are 2 people, the risk of that unauthorized payment going through, it's so much smaller, except if those 2 people work together. Then yes, that's going to be a problem. But if they are individual staff members that must approve the payments, then at least you have covered the risk that there can be an unauthorized payment. Cash receipts should be recorded in such a way that the actual cash received can be checked against an independent daily record. What we're saying here is, when you receive cash, like from customers, when they paid for the transaction, they paid cash, they did not make use of a credit card, then that cash lying there in the business, it can be a risk, because if nobody make proper recordings of that cash can also be taken by somebody. Now, let's say you received 100 Rand and only 80 Rand is now recorded. That 20 Rand you put in your pocket. But again, if there are more than one person handling the cash, like the first person receives it, recorded in a separate book, then, or a separate record, and then a second person must then take it and do the deposit. So the whole time there will be control, because at the end, what is deposited must then be reconciled with what was received, because then you will have 2 different documents, 2 different records. The one would have been when the cash received was recorded, as being received on this day from this customer, and then the second time when it was deposited, then you will have the deposit slip. So you can confirm that what was received was then at the end deposited. Cash received should be banked daily. Now, if you don't do that, the possibility also becomes much higher that that money can go missing. Or if there is people that come to your business, they know that you keep quite a lot of cash with you, they come with their guns, it's a holdup, and they rob you of your cash. So the chance that someone can come and do that becomes so much higher when you don't go and deposit all your receipts per day, the following day, or at the end of the day. So you just create a problem for yourself and increasing the risk that these things can happen. All payments except petty cash payments should be made by EFT. Now, like I explained earlier, when it's done by this way, there will be your payment advice, and then there's also that's prepared by one person, and then the second person that will then approve the payment advice and make then the payment. So again, it's the segregation of duties where there's more than one person involved with the payment. And by doing with an EFT, you have full control that the payment that will go through is then the amount that was approved. The bank statement should be compared with the cash receipts and cash payments journals. The reason why you will do that is to see that, firstly, what was recorded in your cash receipts and cash payments journals were correctly recorded. Because if the deposit that was recorded in the cash receipt journal differs then from the deposit on the bank statement, it can be that the transaction was recorded incorrectly in your books of first entry, in your cash receipts journal. So it's also to check and make sure that there aren't mistakes, errors in your recording, in your accounting records. And secondly, that all cash that was received was then at the end deposited. So that's another control. The same with your payments. When you compare your cash payments journal with your bank statement, you will also first make sure that the amounts agree so that there are no errors. And also then that all payments that are reflected on the bank statement are also reflected on your cash payments journal. Let's say there was an unauthorized payment that went through, you will then pick it up on your bank statement. You will see that there is a payment on your bank statement that's not reflecting in your cash payments journal. And you can't find any payment advice, then you will know that this was an unauthorized, or it can be that it was just the person just forgot to go and record it. So it can be an error, or it can be detection of fraud. So it does show that it is very important to do these comparisons to make sure that you check, but don't leave it till the end of the financial year, because then it's delayed. I mean, every month when you receive your bank statement, you must do that comparison so that when there are mistakes, you can pick it up quickly and do the correct corrections, or to follow it up with the bank if the bank made a mistake, so that everything can be corrected and you know that that your balance as per your bank account in the general ledger agrees to the balance of the bank statement. That's my last bullet on this slide, exactly what I just said. You should reconcile basically your bank account balance with the bank statement so that you know that the amount as per your bank account, it is the same as what's reflected on the bank statement. Especially when you need to make a big payment. And according to your records in your general ledger, you have a favorable bank balance. And when you want to then make the payment, you suddenly find that that bank balance is not favorable, it's unfavorable. That can be because there was one transaction that you never recorded by not comparing your own bank account balance in the general ledger with the bank statement. You wouldn't have found out that your bank balance was unfavorable and you thought it was favorable. So you must compare these balances on a monthly basis so that you know that when you're going to make these payments, that there is money in your bank. So definitely that control of confirming your bank balance as per your general ledger with the bank statement, you will know then of any transactions that either was not recorded on your side or might be an error on the bank statement where the bank must be then advised of that error so that they can correct it. Now, when we look at the reconciliation of the bank statement balance with the bank account balance, every entity entrusts its money to a bank. Because, I mean, you can't put that in your safe or keep it under the bed. I mean, that can't happen. I mean, you might have a bank balance with 100,000 or 200,000 or a bank balance with 1 million. You can't keep it safe at your business. You can't keep it safe at home. So you take it, you open a bank account and you deposit the money there. Now, then it becomes the responsibility of the bank to take care of your money. And in their books, you will be their creditor because the money that you have entrusted with them, the money that you have deposited in an account at their bank, it's not their money. They must only look after it. It's only there for safekeeping because you can't control it yourself. You don't want to take that risk to leave that cash at your business because somebody can come and steal it. So that money that you entrust with the bank, that in the books of the bank, they must record it as if you are their creditor. And we know a creditor is a liability, and a liability will have a credit balance. Liabilities increase on the credit side and decrease on the debit side. So when we talk about the bank statement, because the bank statement is prepared by the bank where you bank, that is basically a view of your account in their books. So when you receive the bank statement, you will see that the balance, if the balance is the same as in your books, it's going to be a direct opposite of yours. What I'm meaning with the direct opposite is if it's in your books a debit balance, that same amount is going to be a credit balance in their books. Because in your books, the bank is an asset and it's basically a debtor. And assets increase on the debit side and decrease on the credit side. And we said that in the books of the bank, you will be a creditor. where a creditor will have a credit balance and increases on the credit side and decrease on the debit side. So just remember that. So in your books, your bank account, if it's favorable, will be an asset with a debit balance. And then your account in the books of the bank, when it's favorable, the same account that I just spoke about, that account will have a credit balance. Because in the books of the bank, you are the creditor. Now, the following will be reflected on the bank statement of an entity. The opening balance at the beginning of the month, because normally we receive bank statements monthly. Like we prepare our books of first entry, our subsidiary journals, what we also call the books of first entry. There we do it on a monthly basis. So our bank statement that we're going to receive will also then be on a monthly basis. Now, deposits credited during the month will appear on the bank statement. Checks paid or EFTs will be debited during the month on the bank statement, because we said the bank statement is from the viewpoint of we being the creditor. So if creditors decrease, it decreases on the debit side. So when we make out a check or do an EFT payment, then that balance in the books of the bank is going to decrease. And therefore, those checks or EFTs must appear on the or in the debit column of the bank statement. Now, the bank will also charge us on a monthly basis with bank charges, because they're not going to do this for nothing. I mean, the safekeeping of the money, the admin fee for processing all the transactions, they charge you for that. And that's where you have to pay then these bank charges. But the bank charges that you will receive or will see on your bank statement, you only see it when you receive your bank statement. It's not something that you will be able to know upfront. It's normally based on the transactions, on deposits, on payments. There's a percentage that you pay for each transaction. So that's calculated. And then at the end of the month, when you receive the bank statement from the bank, you will see your bank charges. And then you will be able to go and record those bank charges in your cash payments journal. The same for your interest charged. If you had an overdraft during the month, the bank will definitely charge you. I mean, they're not going to provide you with an overdraft with no cost, because if they give you an overdraft, it's basically giving you a short-term loan. So, and we know that with loans, we pay interest. That's basically the fee for receiving that overdraft facility. So they will charge you interest when you make use of the overdraft facility on the balance. So it's normally a percentage that will be calculated on the balance of the overdraft. The same with when there's a favorable balance, then you will receive interest, because then you will have money in the bank, you will have a favorable balance, and where you would have had a savings account where you would have received interest, the same now with your current account. When your account is favorable, the bank will pay you interest, but that interest you also will only see when you receive the bank statement from the bank at the end of the month. And that's when you do these recordings. The interest paid will go to your cash payments journal, and the interest received will go through your cash receipts journal. Debit and stop orders for the month will also appear on the bank statement. You might have a debit order for your insurance. You might have a debit order for your armed response. You might have a debit order for your rentals. So those things will appear. Normally you will know about these transactions, but sometimes, you might forget to record it in your cash payments journal. But then when you receive the bank statement, that there you will also then pick up, oh, I forgot to put through these debit orders. So that's something that you also then can confirm when you receive the bank statement, is the debit order, did it go through, and the amount that went through. Direct payments by debtors into the bank account of the entity. When a debtor does not send you information about a direct deposit into your bank account, you will only take note of it when you receive your bank statement and you compare it with your records, and then you see, but here is a deposit on my bank statement which I haven't received, or which I haven't recorded in my records. And then when you inquire about it, the bank will tell you it's this person that did the payment or deposit into your bank account, and you will then trace it and see, oh, it's my debtor, and here's the amount that he paid you. So then you're gonna have to go and correct or update your records, because you did receive this amount. It is your debtor. You then need to go and adjust your records so that you can also show the correct amount that the debtor owes you in your books. Because if you don't record this, then your records will differ with the records of the debtor. So you will then have to go and record that deposit, that direct payment of the debtor in your cash receipts journal. Dishonored checks for the month, checks deposited but not paid by the drawers banks. That's where a debtor previously sent you a check for payment on his account. You would have went and deposited that check which you've received from the debtor. You would have went to your bank, you've deposited the check, and then when your bank wants to clear the check, when they go to the debtor's bank where he banks or she banks, and they want to clear that check with the bank, then the debtor's bank will tell them, but this check that the debtor wrote, our customer wrote, that amount is not in the bank account of the customer, of the debtor. So they can't clear the check. And that's when you receive from your bank this notification that this check was dishonored, meaning that there was not funds in that account of the debtor to clear the check. And where they have previously, your bank has previously increased your bank balance on the bank statement with that amount that you've deposited, they will then have to go and make the opposite transaction, so that to cancel basically that deposit. Now remember, we said deposits will increase your balance. On the bank statement, we say deposits will go to the credit side, because remember, the bank account in the books of the bank is like a liability. Liabilities increase on the credit side. So when you deposited that check into your bank account, it would have reflected on the credit side of the bank statement. But now with this dishonored check, they must then go and do a debit transaction. So on your bank statement, you will then see this RD check, refer to draw. because there's no money in the, or there's not enough money in the account of the debtor to clear the check. So you will only take note of this when you receive that bank statement from your bank, where you will then see this check that you've previously deposited into your account, which is now reversed. And there's now a debit transaction on the bank statement. Also, you will see correction of errors made by the bank in the previous month. So when the bank previously recorded something incorrectly on your bank statement, and you have brought it in on your bank reconciliation statement in the previous month, they will now on the current month's bank statement do the correction. So you will then be able to confirm what you have previously written in your bank reconciliation statement. You will then confirm that entry has now been made on the bank statement, and therefore that error has now been corrected. Because remember, when we do a bank reconciliation, we have basically in our books the cash receipts journal, the cash payments journal, which we then post to the bank account. We receive from the bank statement, but now there might be transactions that don't reflect on the bank statement, or there might be transactions that need to be corrected on the bank statement. Now, we can't do these things on the bank statement because that's the document that comes from the bank. It's not our document. Now, we then use the bank reconciliation statement, which is something that we can prepare, we as the business. We use the bank reconciliation statement to indicate these changes, either outstanding amounts or corrections that need to be done on the bank statement. We then record on the bank reconciliation statement. So if we need to make those entries on the bank reconciliation statement, we're gonna take the same principle that is applied in the bank statement. If it's a deposit that needs to be recorded, then that deposit will reflect on the credit side of the bank reconciliation statement, because deposits reflects on the credit side of a bank statement. Therefore, in my bank reconciliation statement, it will also reflect on the credit side. If there are debit entries that must go through my bank statement, then those debit entries will reflect on the debit column of my bank reconciliation statement. So it's everything that will happen on the debit side of the bank statement will be also recorded on the debit side of my bank reconciliation statement, and transactions that will normally go through on the credit side of my bank statement will also go through on the credit side of my bank reconciliation statement, because that we use to reconcile the balance as per the given bank statement to the balance it is supposed to be according to our records. And any corrections that we need to do in our books, we will physically do in either the cash receipts journal or the cash payments journal. That is when we have forgotten to record a transaction. For example, if we've forgotten to record a cash receipt, then we need to go to the cash receipts journal. If there's a payment that we still need to record, that will go to the payments journal, cash payments journal. So those transactions will happen in our own books, but things that need to be corrected on the bank statement, we will do those on the bank reconciliation statement. Now, why is a bank reconciliation necessary? If a bank and an entity keep record of the same transactions, the balance of the bank statement and the bank account in the books of the business must be the same. Because if you record it in your books and the bank record it in their books, then the balance should be the same. In your books, if the balance is 10,000 favorable, meaning a 10,000 debit balance, and all the transactions were also recorded in the books of the bank, then the bank should have a balance of also 10,000, but a credit balance. In order to ascertain if the bank account in the books of the entity corresponds to the bank statement, a bank reconciliation statement is prepared. This means the balance of the bank account in the books of the entity is reconciled with the balance on its bank statement. So that's basically comparing your balance in your books in the general ledger, then with the balance of the bank statement. Now, this reconciliation process involves two steps. First, the entity's records are updated to account for actual transactions reflected in the bank statement. So those are all the transactions that were already recorded on the bank statement by the bank, but they still need to be recorded in the cash receipts journal or the cash payments journal. Like we've said, examples, bank charges, direct deposits by debtors, debit orders that you've missed, interest paid, interest received on your either favorable bank balance or unfavorable bank balance. So those are transactions that have already been recorded on the bank statement, but they still need to be recorded in either the cash receipts or cash payments journal. So those entries, you need to go and adjust your cash journals. Secondly, those transactions that the bank must still attend to are recorded in the bank reconciliation statement. So transactions that you've already recorded in your cash journals, but they are not on your bank statement. So the bank has not recorded those transactions as yet. So those must hopefully appear then on the following bank statement, but with your reconciliation, you're going to record those transactions that must go through the bank statement. You're then going to go and record on your bank reconciliation statement, because the bank reconciliation statement is a document that you as the business can prepare to reconcile your books with the bank statement. The bank reconciliation could be seen as an extension of the bank statement. An outstanding item that will be credited on the bank statement must be credited on the bank reconciliation statement and vice versa. So what I said, your deposits, which are credits on the bank statement, will be credits on the bank reconciliation statement, and your payments, which will be debits on the bank statement, will be debits on the bank reconciliation statement. A favorable bank account balance is on the debit side of the bank account, as well as on the bank reconciliation statement. So your bank account in the general ledger, when it's favorable, it will have a debit balance, because we said assets have debit balances. So if it's favorable, it will have a debit balance. And when you're going to reflect the balance of the bank account on the bank reconciliation statement, that debit balance will also be then reflected on the debit side of the bank reconciliation statement. An unfavorable or overdrawn bank account balance is on the credit side of the bank account, as well as on the bank reconciliation statement. So then the opposite, when you have an overdrawn bank account, you will now suddenly have an unfavorable bank balance, and that will be a credit balance in the general ledger. And when you show your balance as per your bank account on the bank reconciliation statement, it must also reflect on the credit side. A favorable bank statement balance is on the credit side of the bank statement, as well as on the bank reconciliation statement. We said our bank account in the books of the bank, if it's favorable, then it must be a liability in their books. And when it's a liability, then it will have a credit balance because liabilities have credit balances. So again, with the first presentation, with the first facet class, Mr. Nkari explained all these things and where he gave you all the rules. So you see, it's very important to know your rules, to know what is an asset, what is a liability, what is equity, what is expense, what is income, and know the rules. Assets increase on the debit side, decrease on the assets increase on the debit side, decrease on the credit side. Liabilities increase on the credit side, decrease on the debit side. Equity increase on the credit side, decrease on the debit side. Expenses increase on the debit side, decrease on the credit side. Income increase on the credit side, decrease on the debit side. So these rules, it's basically the foundation of accounting. And you need to know them, but then also you need to know examples of assets, examples of liabilities, examples of expenses, examples of income. But when you get transactions, you must always analyze that transaction to see which element is there. Is it increasing? Is it decreasing? So it's questions that you're going to ask yourself every time. And if you don't know these rules, you won't get to the answer. If you know them wrongly, you can apply them wrongly. So it's very important to know these rules and then to apply them correctly to get to the correct answer. Let's continue with this slide. An unfavorable or overdrawn bank statement balance indicated by DTDR or OD is on the debit side of the bank statement, as well as on the bank reconciliation statement. Now, if you think of a overdraft, when it's on the bank statement, then suddenly you aren't anymore a creditor of that bank because now you owe them money, and when you owe them money, you become a debtor of theirs. So if you are a debtor, then you will be an asset, and assets increase on the debit side. So when your bank account is unfavorable or overdrawn, you will then have a debit balance on the bank statement. So you see, it's important to know when is it an asset, when it's a liability, the rules for assets, the rules for liabilities. Because if you don't know them, you're going to struggle. Now, the procedures that you must follow in the reconciliation process, it's the following. Where a bank reconciliation statement was completed for the previous month, the bank statement must first be compared with that bank reconciliation statement to ascertain if the outstanding items and corrections have been attended to by the bank. So the current bank statement must first be compared with your previous month's bank reconciliation statement. Remember to compare the items on the debit side of the bank reconciliation statement with the entries on the debit side of the bank statement, and credit entries on the reconciliation with credit entries on the statement. Compare the amounts in the cash receipts journal for the current month with the entries on the credit side of the bank statement. So after you have compared your current month bank statement with the previous month bank reconciliation statement, you then take the current month bank statement and compare it with the cash receipts journal. the credit transactions of the bank statement with your cash receipts journal, and then you compare the amounts in the cash payments journal for the current month with the debit entries on the bank statement of the current month. Now, when we have started, we said that most of our cash transactions will be recorded either through the cash receipts journal or through the cash payments journal. But we also have small payments that we need to do for the office normally. Quickly buying something, batteries, or like I said previously, tea, coffee, milk, sugar, bread for the office. Then we don't want to wait for the formal documentations, waiting to approve those documents, get an order. I mean, we quickly want to get money, go and buy, because we need it now. We can't wait. So for these small payments, we will then use the petty cash journal. Now, there are, however, smaller amounts to be paid daily. For example, amounts for postage, carriage, wages, where the amounts are too small for EFTs and cash is needed for the transactions. So, I mean, it's going to be where you suddenly need to get something because you can't continue with what you're busy with because you need something like the batteries. Then you quickly want to go and buy. And it's in any event, you're going to spend more bank charges on that EFT than physically going to take cash and buy that item. So it's all these petty, that's why it's called petty. It's petty payments, petty amounts. That's why it's the petty cash journal. Now, recording is done from suitable petty cash vouchers. So that's your source document. So we've learned about source documents. When you're using the petty cash journal, you will have petty cash vouchers, which you need to complete. It's for internal control purposes, because still, although it's petty, you don't want someone just to come and take money from the petty cash and there's no records. So again, it's going to be stealing, taking money without any evidence. So for every payment that goes through the petty cash journal, there need to be a petty cash voucher, again, with approval and with the necessary documentation, proof, the cash slip, the slip that you received when you went and bought the tea, the coffee, the milk, so that there is evidence and it shows that what the amount that was paid, the amount that you've received, the amount that you've either returned, all these things need to be reflected on that petty cash vouchers. And the necessary authorization by the responsible people need to reflect on that. The so-called impressed system is preferable for controlling petty cash. The petty cashier is provided with a float, let's say 100 Rand. Payments are made during the month, and when necessary, cash is drawn to restore the float of 100 Rand. Now, when you get that 100 Rand, you will then make your small payments. People will come to you. You will, during the month, do different payments, but you need to keep control of how much you have with you, because you don't want someone to come to you and then you don't have enough to give that person, although they know you only keep 100 Rand with you. They can't come and then ask for more than 100 Rand because you only have 100 Rand. So these are going to be, for this specific business, little payments less than 100 Rand. So when you then see that now I only have 20 Rand with me left, you will say, okay, now let's just to have enough money with me to make sure that when the next person comes and asks me money to go and buy what they need to buy. I will be able to provide them with the amount. You will then ask for an imprest, and that's basically filling up. If you have only 20 Rand left with you, it means that you have paid out 80 Rand during the month. It can be different transactions, but you gave people 80 Rand, so you left with 20 Rand, so you therefore need to request 80 Rand again to get your float back to 100 Rand. That's basically how it happens. Here we have just an example. This example you will also see comes from your study guide. I said it's study unit 8. There's an example for Dixon Traders, the petty cash journal for June 20.9. You will see in your petty cash journal, you have basically your receipts and your payments. It's not like with your cash receipts journal and cash payments journal, where those two journals are separate. With your petty cash journal, it's one journal reflecting your receipts. That's basically your imprest when you receive the money to get your float back to the amount that it needs to be. And then on the payment side, it reflects all your payments that you've made for that specific month. And again, these are done monthly. But during the month, if you need to get your imprest, you will request that. But at the end of the month, you will then record all the transactions, all the receipts, all the payments during the month, and you will then at the end post it to your general ledger. Now, during this month, you will see there, if we just look at these transactions, on the 1st of June, you've received an imprest for 300 Rand. Then on the 4th of June, someone wanted to buy some stationery, which cost 25 Rand 20 cents. On the 8th, somebody needed to buy stamps for 18 Rand 10 cents. You see, we also have here the columns for transactions that normally happens frequently, like my wages, my postage, my stationery. Those are transactions that frequently happens. So therefore, we have column headings for those because they normally happen during the month. It's normally what we use for the petty cash for doing these payments. But then you also have your sundries, where it's something that happens not frequently. It might happen once a year. It might happen twice a year. So you're not going to open a column for that specific expense. So that's why we use the sundries column for those, because it's transactions that happens ad hoc. It's not regularly like the wages, the postage, and the stationery. Like we had on the 17th, the advertising cost that we need to pay. The 19th, the wages, the 21st, stamps again, 23rd, paper, 26th, it's wages. And then we had to pay for traveling expenses on the 27th, which it's not done normally or regularly. So we had to then again record it in the sundries column. At the end of the month, you're then going to add up all these transactions. We first do the payment side. When we add up, we get the total of 290 Rand and 25 cents, which comprise of the wages of 180, the postage of 26.60, the stationery of 47.15, and then our sundries, which makes up 36 Rand 50. So add those together, the total expenses are 290 and 25 cents. So that's what we've paid out. So that's also then what our imprest is going to be on the 30th. So you see there the 30th, the 290 Rand and 25 cents. that's because of the 290 Rand and 25 cents that we've paid out. So we were left basically with 75 cents. So to get it back to 300, we then needed the interest of 290 and 25 cents to bring our float back to 300 Rand. Now, we have addressed basically then everything in the cash and cash equivalence study unit. We've looked at our bank reconciliations. We've spoken about the petty cash journal. Now we're going to physically do a bank reconciliation, because that's basically the important part of your cash and cash equivalence study unit. Now we're going to look at revision exercise 1, which you will find in paragraph 8.5.1. So we're physically going to do it. And if you later then also want to go through it again, either you can then again look at these slides, at the recording that will be available afterwards, or you can physically go to your study unit and you can go to revision exercise 1, where you will find this specific question. Now let's look at the information given. The following information for January 20.9 relates to Monday trading. So our business name is Monday Trading. These transactions, they say it's applicable for January 20.9. But then we have here a bank reconciliation statement as at 31st of December 20.8. So that already tells us this is then the previous month's bank reconciliation. So this business or entity has already done a previous bank reconciliation. Therefore, the date of the bank reconciliation is 31st of December 20.8. But we then going to do the bank reconciliation for January 20.9. Now, when we look at the bank reconciliation statement for December, we will note that there's a credit balance as per the bank statement. So that means that there was a favorable balance on the bank statement because it's a credit balance. And when there's a credit balance on the bank statement, we know it's favorable. Then deposit not yet credited. So that means that there was a deposit that was already recorded in our cash receipts journal for December, but that did not reflect on the bank statement for December. And we said deposits reflect on the credit side of the bank statement. So therefore, on the bank reconciliation statement, we must bring it in on the credit side. And then we had the credit balance as per the bank account, because because on the bank reconciliation statement, you reconcile the balance of the bank statement with the balance as per the bank account. And the balance as per the bank account was a credit balance. And if it's a credit balance in our books, in our general ledger, then it means it's unfavorable. So in our books, we had an unfavorable bank account of 200 Rand. And therefore, it's on the credit side of the bank reconciliation statement. Then they provide us with the cash receipts journal for January. Here we have all the transactions that was recorded during the month. They only provide us here with the bank column. We don't have all the detail, which is not necessary because, I mean, the bank column is your important column to work with the bank reconciliation. So on the first, we had sales. Then we had a payment received from a debtor. Then we had sales again, rental income, sales, a debtor that paid us,
and then sales, cash sales and cash sales. So our provisional total for the month of January was 10,150. Then they provide us with the cash payments journal for January 20.9. Here again, we can see all the transactions which were recorded during the month. And there we will see on the third, purchases. We also have then the Sono, who we paid 100 Rand. The municipality we paid for water and electricity 100. Property rates we've paid 50. We have big sales traders purchases, cash purchases. Remember, these purchases are all cash because it's in our cash payments journal. Now, we also had salary payments of 2,000. We paid B Small 400. H Abram, we've paid 50. Big sales traders, we purchased on cash 4,000 Rand. We purchased furniture 2,000. Then petty cash, there was an interest of 100. And then also RCMA that we paid 600 Rand. Now, then we have the bank statement. Now, this is the bank statement for January 20.9. There we see that we have the opening balance, which was unfavorable, because if the bank statement have a debit, the 2,300 is a debit balance, which is unfavorable. Now, we will see that our bank statement, the 2,300, it comes from the bank reconciliation. Sorry, I see here, sorry, what I said in the beginning, credit balance as per bank statement, that's not correct. This should be debit balance. Sorry for this mistake on my side. This is unfavorable, the bank statement. So this is where it comes from. At the end of 31st of December, we had a debit balance, not like what it's written here, credit, it must be debit. So it is unfavorable. It's an amount of 2,300, and that should then also be what reflects on our bank statement. So just to confirm, it says here, my balance of 2,300, it's debit, so it's unfavorable. Then we had these deposits. I'm not going to go individually through them because we're going to go through them when we're going to do the bank reconciliation. So our balance changed from being unfavorable to favorable, and then again to unfavorable. On the third, it went from first being favorable to unfavorable. Again, it went to favorable. So during the month, it went between favorable and unfavorable. And then here at the bottom, we can see on the 28th, there's interest of 15. Now that 15 is on the debit. We know that if it's a debit, then this is interest that we're going to pay. Because if it was something that we would have received, it would have been on the credit side. So it's because of our overdraft that we had during the month. The bank charged us 15 Rand on our bank overdraft. So we're going to pay the bank 15 Rand interest during the month. Then also we have bank charges of 35 Rand, commission on these deposits, cash, commission on also our deposits of 52. And then there's a debit order we have paid Pay Insurance Company 500 Rand. Now, the question also provides us with additional information. It says the debit order of 500 Rand represents the annual inventory insurance premium with Pay Insurance Company. So we know that it's our debit order. We're happy with that. Then they say the deposit of 5,000 Rand, 26th of January 20.9 was made by the tenant of an office, T. Naidu, in respect of the rental for January and February 20.9. Then the cash deposit for the sales on 25 January 20.09 in the CRJ deposited on 26 January 20.09 did not appear on the bank statement for January 20.9 received from the bank. An investigation by the bank revealed that the amount had been deposited in the bank account of Monday Furnitures. The bank will correct this error. On 30 January 20.9, R. Aimer made a direct payment to the business in full settlement of his account of 410. The bookkeeper investigated the fact that the amount paid to a creditor, or SEMA, was indicated as 600 Rand in the CPJ and reflected as 6,000 Rand on the bank statement. Now, this tells us there's some other error. So the bookkeeper then had to go and investigate, because in the CPJ it was recorded as 600, but then on the bank statement it is 6,000. So either it's a mistake made by the bookkeeper, or it can be a mistake made by the bank. So then the additional information tells us that the investigation revealed that the bookkeeper had added an extra zero when paying the amount to the creditor. The bookkeeper contacted the creditor, who said the matter will be investigated, and requested the bookkeeper to put a payback request on a letterhead of Monday Trading. The creditor also asked for a confirmation letter stamped by the bank confirming the banking details of Monday Trading. The bookkeeper adhered to these requests and requested that the amount be paid back. So that means that the 600 Rand in the CPJ is correct, but when the payment was physically done on the EFT, then it went through as 6,000 instead of 600. So 600 was recorded correctly, but 6,000 was then paid, and that then reflected on the bank statement. So this creditor received 5,400 because 6,000 minus 600 is 5,400 too much. So we must receive back that 5,400 from this creditor. Now, in the required part, our first requirement is prepare the cash receipts and cash payments journals of Monday Trading for January 20.9. Then number 2, show the bank account in the general ledger of Monday Trading properly balanced at 31st of January 20.9. Then thirdly, prepare the bank reconciliation statement of Monday Trading as at 31st of January 20.9. Begin with the balance as per the bank statement. So we will now have to go and do the bank reconciliation. Firstly, we need to do the cash receipts and cash payments journals, then go and prepare the bank account after we finalized the journals, after posting it to the bank account, so that we can then prepare the final, or calculate the final balance of our bank account. And then we have to prepare the bank reconciliation statement. Now, when we looked at the steps that we need to take, or the procedure with the bank reconciliation. It said if there was a previous month bank reconciliation done. So if there's a previous month's bank reconciliation statement, that must first be compared with the current month's bank statement. Now we know that there is a bank reconciliation statement for December 20.8. So this must first be compared with the bank statement of January. So the December bank reconciliation statement must be compared with the bank statement of January 20.9. So that's what we're physically going to do. So firstly, we know that our opening balance is correct, because we've noted that this opening balance of 2,300, it reflects, yeah, because it's our debit balance there. So we're happy that is fine. Now here there was a deposit not yet credited for 2,100. So now we must go and see that 2,000, yes, it is. Okay, we're happy. 2,100, it's now been recorded. We say deposits must be on the credit side. We're happy with that entry, it's correct. So we know that 2,100, it's not outstanding anymore. We're going to later come back for this because this is the credit balance as per our bank account. So when we're going to start with our bank account in the general ledger, this is going to be our opening balance. Because remember, this is the closing balance as at 31st of December. And this closing balance will become then the opening balance for the 1st of January 20.9. So when we will prepare that T account for the bank, we're then going to start with this credit balance of 200 Rand. But we must first compare the bank reconciliation statement with the bank statement. We've done that. We've ticked off everything. Now we must compare our cash receipts journal with our bank statement. And we said cash receipts journal, you're going to compare it with the credit column because deposits will be reflected on the credit side of the bank statement. So we must now go and see, firstly, the sales of 1,250. Is it reflected there, or do we have one deposit reflected on the bank statement? So here we have 1,250 that we have for sales. Okay, here's 850. And we have our 300. Okay, so our 1,550 of the first. Okay, that's going to be basically these three. Because it's our 1,250 sales plus the 300, which is the 1,550. Then on the fifth, we have the 1,500, which is basically our 500, 500, plus then the of Okay, let me just see. And then the 500, sorry. That was the, oh, sorry, yeah, that was the 2000. So it's the 1000, the 500 plus, sorry, yeah. It's the 500, 500, 750 plus the 250, sorry. That is our 2000 that we have here. The 1000 plus the 500 gives us the 2000. Then we have the sales of the 19th of 2000, which is going to be here the 400 plus the 5, the 9. Sorry, it's our 500 plus the 1500. That's going to be our 2000. Then we have the 400 on its own, which is our 400 here. Then we have the 1750 and the 550, which will make up our 3000. Wait, sorry, this EFT is not true. Our 1750, that's okay, that's our 1200. Our no, wait, our 1200 has not been reflected. Our 3000 is basically our 1750 plus the let me just see what I'm doing here. Okay, okay. When we look at our additional information, it said that the deposit of 5,000 was made by the tenant of an office in respect of rental for January and February 20.9. Then we also had here the cash deposit on the term deposited on 26 did not appear on the bank statement. Okay, so our entry of the 25th, the 1,000, sorry, going to my cash receipts, the 25th, the 3,000, that's not reflecting. The cash deposit for the sales of 25 in this year deposited on 26 did not appear on the bank statement for January 20.9 received from the bank. Investigation by the bank revealed that the amount had been deposited in the bank account of Monday Furnitures. The bank will correct this error. And then on 30 January 20.9, R. Amer made a direct payment to the business in full settlement of his account of 410. So that still needs to be recorded in the books. The bookkeeper investigated the fact that the amount paid to a creditor or CIMA was indicated as 600 in the CPJ and reflected as 6,000. So that's also something that we need to then go and correct. So here's the 400 Rand that AMER paid to us, and that we need still to go and record in our books. So after we then look at all the transactions that went through on the cash payments journal, our 1,500. There's our payment there of 1,500. Then we must look, here's it's the 100 Rand for S Sono, P852, okay. So P853 is the 150 for the municipality. So here's P853 for the municipality. Then we will look at the following one, P854, which is big sales for 1,300 Rand. Here we have our entry there. Then we must find the payment of the salaries for 2,000. Here's our payment for 2,000. Then we must find the payment for V small of 400. That will give us the 400. The 20th H Abram for 50. Okay, there's 50. 858. It's the 4,000 for big sales. Then there is the payment of the furniture for 2,000, P859. We find P859 for 2,000. Then there's the petty cash of 100, P860, which is that one. And then we have our CIMA for 600, but that's the one which is now reflected as 6,000 here. So we will have to do a correction for that. So we will have to record that one for the correction. So after comparing your cash journals with your bank statement, you must then go and then adjust your cash journals with the transactions that you did not record on the that was recorded on the bank statement but hasn't been recorded in your cash journals. So those transactions you then need to go and still do. Now here we have our cash receipts journal that we're going to complete. So first we must start with our subtotal that we're going to find from our provided cash receipts journal. Now we know this total was 10,150. So we're going to start on the 30th or the 31st with this total of 10,150. So when we start our cash receipts journal on the 31st, we will start with our subtotal and our subtotal is 10,150. Okay. Then we must now go and look for all these transactions that went through the bank statement but did not reflect on our cash receipts journal. Now, firstly, this 5,000 Rand paid by T Naidu, like we said, the deposited the 5,000 by the tenant. This must be still recorded because it was only done on the bank statement. It was not recorded in the cash receipts journal. When we look here, there's no deposit of that 5,000 recorded here. So we will then have to go and record that rental income of T. Nyder. So in our document, we can just refer to the bank statement, and that comes from the first month, and it's gonna be, we can just see which deposit. It's basically a direct deposit. The Baloy was the first one, then M. Nkosi, T. Nyder. So it's the third EFT payment that we've received. So for our purposes, we can just then refer to it. It comes from the bank statement of the first month, and it's the third EFT payment that we've received for that month. And that's from T. Nyder. And that's regarding the rental income. And that was for the amount of 5,000 rand. Then we have also, if I can remember correctly, we said from the information that on 30 January, R. Aimer made a direct payment to the business in full settlement of his account of 410. Okay. Let's just check on the bank statement. Okay, here he only paid us 400, but so that means that Aimer took settlement discount. So he probably had we probably told him that if he pays us, let's say within 30 days, he can then get a discount, which he then took. And although that information tells us he owed us 410, he only paid us 400. So we gave him settlement discount of 10. So that is something that we're going to record separately, that settlement discount that we allowed. But for the bank reconciliation purposes, that's not going to affect our transactions. So when we record, we must physically only record the amount that was physically received. We only received the 400 Rand. So therefore, when we record this transaction, we're only going to record the 400 Rand. So in my amount, it's going to be the 400. It's my balance sheet coming from January. That's why I'm saying it's 01, and it's basically the following entry because the 5,000 was the third one. So this is the fourth EFT payment that we've received for 400 Rand. That will be then 04. It's R. Aimer for my trade receivables control. And that was for the amount of 400 Rand. Now that, if we check, compare, we would have noted the 5,000, it's done, the 400 is done. So now we're happy with all our deposits. We've recorded everything. It's either in the bank statement or it's on the cash receipts. except for the correction that we must do. But that's later when we work on the bank reconciliation statement, because that's something that the bank must correct because the amount went into another customer's bank account. So they still need to do that correction on their side. So that's something that will reflect on the bank reconciliation statement, like we said here. So now we must go back and we must go and do the cash payments journal. Now everything was ticked off here. So we must just see which transactions here have we not recorded. So in here, well, first we need to go back and get our subtotal. If we add everything up, we will note that our subtotal is 12,200. So when we start our cash payments, I'm going to start with the subtotal. And when we add up our cash payments journal before all these entries, it came to 12,200. Now we must record all those transactions that are reflected on the bank statement, but must still reflect on the cash payments journal. So we will go back. Firstly, our interest, and remember I said this is, it's interest paid because it's on the debit column. If it was interest received, it would have been on the credit column, but this is interest paid. So our interest will reflect in our cash payments journal and not our cash receipts journal. Okay, so let's go and record that. We will say banks, also the bank comes from the bank statement. And it's the first one of the year, January, and that will be payment 1. Okay, and that's our interest expense. And that's for the amount of 15 Rand. Then we go back. We will see that there's bank charges. Now, remember this commission on all your deposits. That forms part of your bank charges, although it's shown separately because this bank charges could be for anything like if they printed material for you for the bank statements itself that they provide you with, then also on these commission on your deposits, when you make these deposits, then they charge you a certain amount per deposit. So they will reflect them separately on the bank statement. But when you're going to record it in your books, these are all part of your bank charges. So you're not going to show them separately because they all are at the end bank charges. So we're just going to make one entry for those. So we're going to take the 35 plus the 52 plus the 18, which will then give us 105 Rand. So we can go to our cash payments journal. Again, it's our bank statement, first one of the year, coming January, being the first month of our financial year. And it's going to be payment 2, going to be our bank charges. And that will be the 35 the 52 plus the 18. I mean, you can just show your calculation, how you have done it. My 35 plus my 52 plus my 18 rand. And that will give us the 105. Then let's go and see what we still need to record. Oh, there's the debit order from Pay Insurance Company, 500. So that we still need to go and record. Okay. So that is still an entry because we did not record it in our cash payments journal. We forgot about that one. And we were also told about this debit order that went through. Okay. So we will say bank statement 01 +3, and that's going to be Pay Insurance Company or insurance, and the amount it's 500 rand. Then just go and check again. But the bookkeeper investigated the fact that the amount paid to a creditor Osimo was indicated as 600 CPJ and reflected as 6,000 on the bank statement. So that is the mistake that still needs to be corrected. This entry of 6,000 rand, which must be corrected in our books. We've only shown it as 600, which should be the difference between the amount of 600 and 6,000, which is the 5,400. So that we must still record. Now here we will say, okay, bank statement 01 304 Osimo, which is our creditor. Made payables control. And that is basically the 6,000 rand minus the 600 that we've. There's another 5,400 that needs to be recorded. So we know now that we've addressed everything here. So everything that was on the bank statement, but was not either recorded on the cash receipts journal or on the cash payments journal, we've addressed. We've done the first part, comparing the bank statement with the previous month bank reconciliation statement. We've compared now the bank statement with the cash journals, the cash receipts and the cash payments. So now we must physically just go and do the bank reconciliation statement. So everything here has been addressed, except here the cash deposit for the sales on 25th January in the CRJ deposited on 26th January did not appear on the bank statement. So that must still be recorded, but that is something that must appear on the bank statement. So it's not on the bank statement. So therefore, that's going to be an outstanding deposit. Okay. So when we go to our bank reconciliation statement, oh, well, sorry, no, let's first, we need to post everything that we have recorded in the cash receipts journal and the cash payments journal. We must go and first post them to the bank account so that we can then prepare our balance as per the bank account in the general ledger. So we now must go and add up. We start with the subtotal of 10,150 plus then our entry of 5,000 plus then our 400. If we add up, we will get then our total of 15,550. Okay. For the cash receipts, the cash payments journal, we had a subtotal of 12,200 before we then recorded the interest expense, the bank charges, this debit order, and this correction. So when we add up everything here, the 12,200 plus the 15 plus the 105 plus the 500 plus the 5,400, we then get a final total of 18,220. So that's our cash payments. So we will then have to post those to our bank account. Now, with our bank account, we know that we had the opening balance because the balance as per the previous month's bank reconciliation statement was given here. So we had a credit balance as per the bank account, which means it was a bank overdraft of 200 Rand. So we will then use our 200 Rand to start our bank account in the general ledger. That's going to be our opening balance for the 1st of January. So we know it is an overdraft. It's an unfavorable. It's said there on the bank reconciliation statement for December. At the end of December, there was a credit balance. So therefore, it will be on the credit side. We also know a bank overdraft will be a liability. So therefore, it will have a credit balance. So we know that that opening balance must be on my credit side. So here I will have for January the 1st, I will have a balance brought down of 200 Rand. So that's what was given in our bank reconciliation statement. Now we know cash receipts will increase my bank. My bank is an asset and it increases on the debit side. So this 15,550 will go to my debit side of my bank account. So here I will have then at the end of the month, January the 31st, I will have my total receipts and they will come from my CRJ, my cash receipts journal. That's what I put here in my follow column. Tells me from which journal it comes. And the amount is 15,550. Okay. Then we know our cash payments. That will decrease because it's payments. Payments decrease my balance of my bank account, and a bank being an asset will decrease on the credit side. So therefore, my total payments must reflect on the credit side of my bank account. So on the 31st of January, I will then have my total payments, and that will be coming from my cash payments journal. My amount is 18,220. Now, after I've done this, I must balance, because the question said I must balance show the bank account in the general ledger of Monday trading properly balanced at 31st of January, because we need that balance when we're going to prepare the bank reconciliation statement. So we must now balance our bank account. And to balance a bank or any ledger account, any asset account, liability account, equity account, where there's balances, because remember, your assets, equity, liability accounts have balances where your expenses and income accounts have totals. When you want to balance these accounts, you must first look and see which side is the biggest. Now, on my debit side, I have 15,550. On my credit side, I have 18,220 plus the 200. So I can see my credit is going to be bigger than my debit. So what I have on my credit side will then be my total for my account. And then I will have to go and balance the side, which is the smaller amount. So what I then first do is, after I've confirmed that my credit side is bigger than my debit side, I then use my credit side as my total. So when I add my credit side together, it's 18,420. I know that on my debit side, my total must also be 18,420, so that I then can balance my account. Now, to balance it, it's basically the difference then between my 15,550 and my 18,420, because I must add an amount to my 15,550 to get to 18,420. So if I take 18,420 minus 15,550, I will get the amount of 2,870. So 15,550 plus 2,870 will give me 18,420. And that will be my balance carried down. Because remember, my opening balance is brought down. My balance my balancing amount will be my balance carried down, and that balance carried down will be then the next month my balance brought down. So here for Feb, on the 1st, I will then have a balance brought down of 2,870, because it's still a overdrawn account. It's still an unfavorable account. Now that I've prepared my bank account in the general ledger, I then can now go and prepare my bank reconciliation statement, because now I have my balances so that I can then compare them. And the question said we must start, if I can remember correctly, prepare the bank reconciliation statement of Monday trading as at 31st of January 20.9, begin with the balance as per the bank statement. Now, we know our balance as per the bank statement. That we will find here, because that's my closing balance as per my bank statement. So we know that the 4,770 is according to my bank statement, my balance. So it's an unfavorable balance on my bank statement. I know when it's unfavorable on my bank statement, it will have a debit balance. So when I then go to my bank reconciliation statement, I start then with my debit balance as per bank statement, and the amount is the 4,770 as we have seen on the bank statement. Then we have a correction of an error where it was an amount of 3,000 Rand, which was reflected as 2,300, and we still need to correct that so that it's only the 700 Rand that we must still see on the bank statement. So the correction of the error of 2,000 minus the 2,300, and that is the credit of 700. Okay. Then we have the outstanding deposit. We have credit of outstanding deposit. It is the 1,200. Because they said here the cash deposit for the sales on 25 January in the CRJ deposited on 26 January did not appear. So this is the sales here, the 1,200. With our previous one, it was the 3,000 that was shown incorrectly as 2,300 for the bank statement. And that's why we had to then correct it with the 700 that still needs to be corrected on the bank statement. Now, the outstanding deposit is that 1,200 that is on the CRJ, but it's not in the bank statement. So that's why we still have to record the 1,200. And then we should have all the transactions, because the 1,200 is then also recorded. We've done the correction for that 3,000 on the bank statement. Then we can basically just bring in our balance as per the bank account, and that we said is going to be a credit of 2,870. So it's my credit balance as per bank account, my unfavorable balance, and that is my 2,870. So if I then gonna total everything, I know on my debit side it's 4,770. If I add up 7, 0, it's going to be 9, the 7. So it's also 4, 7, 7, 0. And that is your bank reconciliation. So there you can see you have your debit balance as per the bank statement of 4,770, and you have your credit balance of 2,870. You have this outstanding deposit that must still go through the bank statement, this correction of 700 that must be done on the bank statement. And then after you have done those things, if you corrected this 4,770 with the 700, with the 1,200, your bank statement will then reflect, as per your bank account in the general ledger, a balance of 2,870. I hope you all know now how to do a bank reconciliation. I hope it's clearer. If you have went through this previously and you were not certain how to do it, I hope you now know how to do it. I think this then will be the end of my presentation. I just want to check, are there any questions?
Hi, Dion. There are no questions on the chat box yet, because we did actually address the ones that were raised. So yeah, we don't have any questions yet.
Okay. I think then we will come to the end of this presentation. I just want to wish you all the best with your studies. I hope you've gained from this presentation. And if you have any questions, you can then send them to us. And enjoy the rest of your Sunday afternoon. Then from my side, I'm going to say goodbye.